Yeah, hi everyone. Good to see everyone here. Tonight I'm together with Tarek, having to hold the fort. Ben and Ferris, they are at an offsite meeting, and actually Tarek is too. He just stepped out to help us out here. And our team in Dallas, Fort Worth, unfortunately, also cannot make it because they are traveling or on meetings. So you have to deal with me all night long.
I'm here, Anton.
Oh, you're here. Hi, John.
Hi.
So just a quick introduction. So Multifamily Master is a networking group that is nationwide, and Ben and Ferris, they are the founding members, and John and I and Ronnie, we are the Dallas chapter leaders. And once per month, we organize a virtual meetup, and that's the one you're on right now. We also are having some physical on-site meetings. We only had them regularly pre-COVID. Down in Houston, they have restarted them. Here in Dallas, we are in the process of ramping it up again. So my name is Anton Mattli. I'm co-founder and CEO of Peak Financing. We arrange financing for commercial real estate with a particular focus on multifamily. We help a lot of syndicators as well as private individuals, as well as larger investors with their financing. I personally have been involved in commercial real estate now for around 30 years, and have also personally been investing in various asset classes. And despite of all what we have been seeing, I'm still like multifamily the best when you stretch it out over a longer period of time. So with that, I pass it on to John.
Yeah, thanks, Anton. John Montero here. I am based also in the Frisco, Texas area, just a northern suburb of DFW. I am also primarily focused on the multifamily business, both in terms of acquisitions of existing value-add assets, as well as ground-up multifamily. So we also build ground-up also in the primary markets of DFW, Houston and Austin submarkets. So happy to be here. Thanks for joining us this evening. You're in good hands with Anton. I wouldn't have missed this one for anything. You got a very, very experienced, seasoned veteran on the line tonight, and I'm excited to get the latest updates on what's going on in debt markets.
All right, very good. Appreciate it, John. So just to give you a little bit of a picture here, so I have a couple of slides, but it's not just meant as me just talking, so please ask questions, and I'm happy to answer them throughout the evening. After we are done with that segment, what we always do, and some of you are regulars, you already know that we are doing some breakout rooms so that you can network in some smaller groups. So that's how the evening is planned. And so let me start here. As I said, I have a couple of slides, so I'm sharing that, and then we can start.
Right before you start, Anton, I want to make sure everyone knows to go ahead and type in your question into the chat box, and we'll queue them up for Anton to see them and address them, please.
Yeah. Thanks, Tarek. So let's see here. Do you see my screen?
Yep.
All right. So we talk a little bit about where we came from, where we are today. And then I just want to touch on a couple of financing strategies if you have already a loan in place, particularly a bridge loan, and also what you should look for when you look at buying a new property. So just tell me, do you see, because I cannot see it, that's unfortunately with Zoom. So right now you should see the screen with federal funds rate. Do you see that?
See it.
All right, very good. So what is really interesting, right? So we all know about the Federal Reserve having raised rates very aggressively over the last couple of months, I would say the last essentially since March, when they started a complete turnaround from the dovish behavior that they have displayed for not just for years, but really for a full decade. And when we look at where we were in 2008 and all the way to 18, we were already at a very low rate environment, and that really was the first time ever that we were at such a low level. As you can see, you certainly have had some dips, right? But overall, we have never seen that low level ever before, and that was before COVID. And obviously, that was after the great financial crisis, and they kept the rates really low. We went into 2018 here, and that immediately created already market turmoil. Certainly on the residential side, it already had an impact, and obviously it had an impact also on the stock market. So the Fed already felt at that point that the market was kind of overheated, and that's the reason why they did that. So now, just looking at it a little bit in a shorter time frame, again, we have that typical way of how these rates evolve, right? So we have a boom, so then they go up with the rates, and then we have the recession here, and we have had the same thing. They already felt that there is really an overheating in the market in 2005 and 2006. They started raising the rates, and that, together with all the arms that were in place, together with the LIO loans, as they were called, on the single family side, obviously the whole debt market collapsed when it came to residential real estate, and that's why we had then the recession and immediately dropped the Fed rate very aggressively there. So then after that, we really had a long period of very low rates. I believe that was really unnecessary to keep the rate at that level. But again, that was the dovish stance. They briefly went here and decreased it. And then we all know what has happened here. We had COVID, and after that, the Fed rate essentially went down to zero, together with all the stimulus, trillions of dollars that were put into the economy. There clearly, when you listen to Powell today, everyone now at the Fed realizes that they waited too long with the tightening, and that's where we essentially are today. Now, that's what really has happened here, right? So that was in 18 where they tried it, and now we had that period here where we were at the very low level, essentially zero, and we have never seen something like this ever, where they not just increased the rate a little bit, but essentially multiplying multiple times from a very low level. And naturally, that has an impact on the debt market. And no one is borrowing in the economy other than banks at Fed rate. So we have the secured overnight finance rate that is now the new rate that is generally used for a lot of commercial lending that is short-term lending. It replaced LIBOR, and even though LIBOR is still around, SOFR, as it's called, is really now taking its place. And naturally, as Fed rates move up, the SOFR is also moving up. So we were with SOFR doing the period in here, we were virtually at zero, right? And we talk about 0.5%, and today we are at more than 3%, right? So when we talk about bridge loans, that's a massive impact that we have seen here. Now, the 10-year Treasury, that is kind of the gold standard when it comes to permanent financing for commercial real estate, also for some longer term corporate debt, but certainly when it comes to CMBS loans as well as agency loans. And many of you have been in transactions with Fannie and Freddie loans that were 10-year loans. They are all based on the 10-year Treasury. And naturally, we have had, again, when we look at this year, at record low levels, and that benefited us for a very long time. And now, unfortunately, that music really has stopped, where we are now at the 3.9% level, comparing it when we were at the low. Briefly, we were at around 0.5%, right? So again, it's a multiple, and this is really the hard part here compared to even when we compare it to the high inflation years in the 70s and 80s. They moved up significantly, but they did not multiply from a very low level. So that's why the shock that we have been experiencing is so much more felt in the current environment. Now, what does that do to interest rates, right? So it's important, again, to understand that when we talk about bridge loans, they are mostly based on SOFR now. Yes, there are some fixed rate loans that are out there that virtually have disappeared. Some banks might still offer fixed rate loans, but very few of them still do it. Now, we have arranged a number of bridge loans with banks in the past when they were willing to do fixed rate loans for 3 years, 4 years, 5 years. All of them now, the larger ones that are able to do larger type of loans like 10 million, 20 million, 30 million, all of them shifted over. I do not know of anyone that is still offering fixed rates. So they all now moved over to SOFR. Or then if they offer a fixed rate, it's such an expensive loan that it just doesn't make sense anymore. So when we look at the SOFR rate, again, it was essentially at zero for a good part of the pandemic. And that, together with the stimulus money, obviously initially in March 2020, everything stopped. And we really can say that the music for any type of commercial financing stopped for around a week or two. It was panic in the market, but it recovered relatively quickly. Bridge loans, they suddenly disappeared for a month or two, and they slowly came back. Agencies continued to lend, which certainly has helped during that period. But bridge lenders were far and few between during that time. The ones that were active, though, were still offering pretty attractive spreads. So you were still able to get a bridge loan somewhere around the 4% mark during that time. So actually pretty good. Now, obviously, we have that situation now when we look into 2020, late 2020, and particularly 2021. There were so many bridge lenders through debt funds primarily that joined the frenzy of lending to multifamily. As a result, not only was the SOFR at essentially zero last year, but the spreads also came down on the bridge loans. So you were able to get a bridge loan roughly around 3% all-in rate, right? Now compare that with today. Now we are with spreads also having gone up, SOFR having come up dramatically to the 3% plus mark. Now we are at roughly 7% for bridge loans, right? And again, the same deal, same type of sponsors would have gone around 3% as a start rate a year ago, right? Obviously, that creates a lot of stress, and we have seen a lot of retrades, and you probably, if you're in the market, you have seen some retrades with transactions. Now, when it comes to agency loans, unfortunately, we have seen the same situation there when it comes to the actual all-in rate, because as we have seen, the 10-year Treasury also has moved up drastically over that time period from roughly a year ago, right? What is positive solely with the agencies that they have, and this line here is the spread. They have kept the spread at the very low level, and in recently they actually have lowered it. So they really have tried hard to keep the pain to a minimum as possible, but nevertheless, the all-in rate obviously is still very painful. So now for a 10-year fixed rate with maximum affordability, with maximum leverage, you will be around the 5.5 mark. For a lot of deals, it's closer to 6%. And if you have a smaller balance loan below 6 million, or 7.5 million if it's 100 units or less, you will see interest rates more in the 6.5 to 7% mark, depending on the market where you're in and the affordability that can be applied. So a very different environment compared to where we were just a year ago. Right now, this actually has a big impact on the bridge loan underwriting too, right? So bridge loans have the intent that they are taken out within roughly a 3-year period when the so-called stabilization takes place. A year ago, most bridge lenders were underwriting these so-called exit scenarios with a fixed rate 30-year amortization loan somewhere at 3.75 to 4%, right? So now obviously that is now 1.5% plus below of where the actual exit would happen as of today, and that doesn't even include a cushion. What does that mean? Now bridge lenders have to underwrite to that much higher rate, which means that with the same NOI that you're projecting, your loan proceeds will be lower because of that, right? And any one of you who have been in applying for a bridge loan recently, you may have experienced a retrade doing the application, or if you go into a new loan, more likely than not, your loan proceeds will not be as high as what you anticipated, because again, that exit test is making it so much harder to get to the numbers as they were able to get to a year ago. A year ago, it was normal to have 80% LTC. Today, it's more normal to be around the 70% mark. In some cases, it's 65, but there are not that many deals that can be stretched above the 75% LTC, again, primarily because of that exit test. Now, what do you do when you have a bridge loan in place and you have to do obviously something about it, right? Do not just focus on the income stream. We have seen it now in a number of instances, everyone is focusing on rents, collections, but expenses are, particularly in markets like Texas and Florida and Georgia, mentioning these markets because a lot of syndicators are active in those, taxes and insurance, particularly in Texas and in Florida, are just runaway costs. And it's really important to keep a track on that and just understand that, yes, the income stream has been improving quite a bit, but you may not really have that positive impact on NOI. Now, with that, it's really important that you closely monitor the loan covenants with your loan, right? You may think, well, I have my top line has improved, everything looks great, the lender should be happy. Well, not necessarily, right? Because again, the loan covenants are in most instances based on the NOI, and if your NOI is struggling, you may trigger a cash management trigger, which means that if you fall below a certain so-called debt yield or a debt service coverage ratio, that they are able to take over the cash management, sweep it into their account, and that's extremely painful for an operator. So make sure that you know where these covenants are and how much cushion you have, and if you feel that there might be an issue, start taking action early on rather than just hoping for the best, because I can tell you, lender, their servicers, they are monitoring it very closely. Now, that really applies also not necessarily for today, but also looking out maybe a year, maybe 2 years, right? 90% of all multifamily loans in 2020 and 2021 and early 2022, and even today, a large percentage, but it's only during that period, were all done with bridge loans. And we talk about small loans to massive loans, right? So there are a lot of bridge loans that are out there on these multifamily deals. And naturally, the intent was to either sell in year 3 or refinance in year 3. So with the rates moving up, with cap rates also adjusting to that, you may not be able to get all the sales price that you thought that you're able to get, but you also have, and then you say, well, then I just refinance. Well, you have to be sure that you actually meet the covenants of your existing bridge loan, that if you cannot refinance because you still need to meet that LTV and debt service coverage ratio to actually refinance into a permanent loan. So if you are not ready yet for whatever reason, make sure that your covenants are there that allow you to extend that bridge loan, right? So read through your loan agreement, check the covenants that are ongoing covenants that you need to meet, as well as look at what the covenants are that you need to meet to extend that loan if necessary, so that you are not caught by surprise and that you already can get ready for that. right? Now, another aspect is most of you hopefully have an interest rate cap in place if it's a floating rate bridge loan. So that's great. That's usually in place for the first 3 years. Some lenders allowed you to do it just for 2 years, even though it was a 3-year term. But let's assume that you have it in place for the initial term of that bridge loan. Well, if there is a risk that you need to extend that bridge loan, you will also need to buy a new rate cap, and naturally that costs money. So make sure that you understand how much as of today, and you can adjust that pricing and cost on let's say, monthly basis, that you know what that cost is, and that you start setting aside funds so that once you need to buy that rate cap when you extend that loan, that you already have the funds available and that you do not have to pull it from operating reserves, or inverse, that you have to do a cash call from your investors, right? Again, I mentioned that before, please regularly reassess the projected NOI that you think that you will achieve at the maturity of that loan, or when you want to refinance and even sell the property, because someone might not want to get a bridge loan but want to get a permanent loan at that point. So make sure that your projected NOI, based on today's interest rates and cap rates, that you can get the LTV that you would likely would apply to that loan at the time of the refinancing. Now, one important point is, and we see that still regularly, even with the more experienced operators, the assumption is, okay, we refinance in year 3 and we have 3 years of interest only, let's say, right? That's fine. Just be aware that lenders are underwriting that loan with the amortization built in. So even though your actual monthly payment will be just interest only, the actual underwriting to qualify for that loan includes the amortization. So just be aware of it so that you're not getting caught off guard. Now, when it comes to buying a property in the current market, obviously there are some challenges, but there are also opportunities. Right? The opportunity naturally is that if you're in the market, you already have seen weakness, right? Existing deals have been retraded anywhere between 3% all the way to 15%. The largest retrade we actually have seen was 20%, but that's only the exception. Most of them have been retraded somewhere between 3 and 7, 8%. But if the same deals came onto the market today, more likely than not, there will be 15 to 20% below of where the broker and the seller thought that it could sell it for just 6 months ago, right? So that's definitely an opportunity, right? Having said that, the prices are not necessarily still appropriate, if you want to call it that way, for the borrowing costs that you have, right? So what do I mean with this? There are still a lot of deals, stabilized deals, that are trading around the 5% cap rate mark, some of them even below, that are not value add properties. Yet, if you wanted to go into a fixed rate loans, your borrowing cost is already at 5.5% plus. So you're really starting out immediately with a negative leverage. And unless it's a true value add deal, you do not want to be caught in such a situation, right? The reason why you can do it with a true value add is because there is a true value. So obviously the going in cap rate tends to be low. But if it's a fully stabilized property and there is very little value add, then just be careful that you're not getting caught with that, right? Now, also, let's say that you found the property and you're happy with the price and all that. You go into loan application, the term sheet comes back with the numbers that you're happy with, and you are all rolling along with it. You raise equity and you think everything is fine. Well, the problem is, as we have seen, I would say the first time in March, and then particularly in June, early June this year, when there was a clear pivoting by the Fed, also from a messaging perspective, the debt market started to freak out. So back in June, everyone freaked out. Everyone increased the spread for a brief period of time. Everyone increased the exit tests beyond of actually where it was absolutely necessary, because again, when everyone is afraid, when they cannot sell these deals these loans into the market, then everyone is stepping back and tightening up. So just be aware that even if you apply today, your loan closes likely in a best case 40, 45 days out. In a lot of instances, it's 60 days plus out. A lot of things can happen during that time, right? We have a new Fed meeting in November, depending on the messaging, maybe, and how much they raise the rate, maybe the Fed rate, maybe there is another freak out in the market. Just be prepared for that. We just never know, right? So that you raise enough equity, that you have that cushion in place, that you are not then suddenly attempting to close and you don't have enough funds to close. With that, I would say I would certainly consider now to go with a lower leverage so that you can get a permanent fixed rate loan. Definitely for stabilized properties that have very little value add elements to it. The reality is, because of the leverage that everyone was able to achieve, again, 90% of all the buyers went with bridge loans, even for stabilized properties during the last 2 years. I would say that's probably not the right strategy today. For these stabilized properties. And again, everyone can call it value add, but in a lot of instances, they are just not true value add. So yes, you need to raise more equity, but you also have, thanks to the cushion, you will sleep better and your investors sleep better. Now, when you do a floating rate loan, right, because you can get a permanent floating rate too. Fannie and Freddie offer them. But you just also need to consider the high cost of the interest rate cap that you have up front initially for whatever period Fannie or Freddie will require them, let's say for the first 3 years. But assuming that you want to keep that loan longer than that, you need to already prepare yourself for buying a replacement cap in, let's say, at the end of year 3. So that is an additional cost that you also have to consider. You really should have to escrow it within in-house so that you're ready for that. And when you look at this all together, it's not necessarily better to go with a floating rate loan unless you have that strategy to sell that property very quickly, or again, if it's a true value add deal. But that's, again, just to take a floating rate loan to get a lower rate for a fully stabilized property is only not ideal for many sponsors. So experienced sponsors might be okay, but I would be careful with that. Then also, we have seen it multiple times. We just got a request today whether we can find a loan, second lien for a project that was started in February, and they already ran out of money. So obviously they budgeted based on where the costs were anticipated, based on what the GC told them back at the end of last year, early this year. They closed the loan in February, and they are now short already of the capex, and they are halfway through. So just be aware that we see it across the board. These rehab capex expenditures tend to be much higher now than they were. Yes, everyone talks about lumber came down price-wise, but it's not just lumber. It's really, particularly with rehab project, lumber is the least of your worries there. And very often you do not have access to equipment, so you need to pay whatever you need to pay to get that equipment in. And along the same line, just increase your operating reserves for unanticipated lower collections, as well as increased operating expenses. We already have seen quite a number of deals where there is some weakness on the collection side, where delinquencies have gone up. So obviously, it's always the hope that your property will be shielded from that, but you just do not know, right? So in summary, when you buy a property today, be more conservative, raise more equity, and you and your investors will sleep better. And as long as the numbers still make sense despite the lower leverage, then you have a good deal, right? All right, so here are my contact details. Now, let's see here. Tarek, are you still here?
Yes, I am. Thank you for that, Anton.
Okay, so I do not know whether there are some questions there in the chat. I haven't checked yet.
Yes, so this is our first one. So is due in 3 years. What year do we need to start escrowing for rate caps for loan extensions? And in the meantime, while answering that one, Anton, if anyone else has any questions, please do go ahead and type them into the chat box.
Yes. So what was that question? I didn't. Oh, okay. So if bridge loan is due in 3 years, at what year do we need to start escrowing for the rate caps? It all depends on what your agreement is with the lender. Very often there is not really a requirement for the bridge loans. Right, so with agency loans, it's a little bit different because they want to continuously have the new rate cap covered. So they will start escrowing essentially right from the beginning, and they will readjust that as the cost goes up or down if it happens to go down. Now with a bridge loan, in most instances, they do not require you to escrow during that period at all, because their understanding is that you are not really extend that loan, right? So these are extension options, but they do not expect you to really to extend it, right? So as a result, they are also, in most instances, they are not requiring you to escrow for that. Having said that, it doesn't really matter whether they are requiring or not. If you must extend, they will require that rate cap. And if you do not have the funds, then you need to find the funds somewhere.
Great, thank you, Anton. The next question we have is, what percent of your business today is agency versus bridge versus bank versus loan assumptions?
Yeah, for acquisitions, it's still a majority still are bridge loans. plainly because of the interest rate increase also on the treasury side. Agency loans still today, most of them come in somewhere between 50 and 60% leverage, even with the price reductions that we already have seen, right? But with that rate increase, essentially nulls that out. So that's the reason why still a lot of people are willing to go with a bridge loan. However, we only have seen now more and more buyers willing to go down a little bit more with the leverage and go into an agency loan. And the reason for that really is that, as I mentioned before, until a year ago or even 6-7 months ago, it was quite common to get to 80% LTC with a bridge loan. Today, we are very often in the 65 to 70% range. So we are not that far off anymore from where we potentially can be with an agency loan. And if the price is right, then you definitely have buyers that are willing to raise more equity and go with an agency loan. So now I'm talking about syndicators, right? When it comes to institutional buyers, they are all going with agency, right? But they always have operated with lower leverage to begin with, right? So they are used to 55 to 65 leverage, so that doesn't scare them. They also are now mostly going for newer assets, and with that, again, it just makes more sense for them to go with agency loans. Now, I think, John, you also asked about banks. Certainly, banks have played a much stronger role. For a brief period, they were extremely attractive because they were willing to go with fixed rate loans. Unfortunately, that window kind of has closed. Typically, with most banks for bridge loan type of products, they want to see some form of a recourse, usually around the 20% mark. But they are still attractive because the spreads over SOFR, even though they are floating, are definitely lower. So typically they are somewhere around 100 to 150 basis points lower. So if you have a debt fund coming in around the 4% mark, which is kind of common today, we still see banks for these larger deals coming in somewhere around the 2.5 to 2.7 range on the spread. So yes, you get that partial recourse piece, but it's only is much more attractive from a total rate perspective. Also, very often they do not require rate caps. It doesn't, in my view, that shouldn't really matter, because I always advise everyone to buy rate caps, whether it's required or not by the lender. But at least if you are really aggressive and you feel, look, rates are coming down next year, we see have a recession, whatever, you can roll the dice and actually go without a rate cap. You may just put the money aside and say, look, instead of paying for that expensive rate cap, we just put it aside and hope that our gamble is right. So that could be a strategy, but again, I only advise that for very experienced operators. And also just the overall paperwork and process is so much easier with banks than with debt funds, and never mind the cost. Now, John, when it comes to loan assumptions, we have seen some. Unfortunately, there are not really that many deals out there where if someone has really an attractive loan that they are willing to sell it. So whenever you see one, whenever you find one, it's great to have. And obviously, in ideal world, you can do that off market, because I can guarantee you if it's on market or off market, but widely circulated by the broker, the competition for these deals will be very significant. So yes, you may get a great loan assumption, but the disadvantage is that the price of the deal is likely also going up.
Great. Next question, Anton, is what rate cap on SOFR are you seeing most syndicators getting in the current markets? Is it still 2, even though SOFR is already close to 3?
Oh no, that's not the case. I would say most lenders today require a rate cap around the 3% mark. We try to if a borrower doesn't really want it that tight, we try to negotiate to get it up to 3.5. But I would say most lenders will want it at the 3% mark.
Got it. And kind of tying back to your prior question that you answered regarding the different loan types, John Montero has a follow-up question, which is that bridge lenders collateralize their loans and sell them into the CLO markets. The CLO markets, however, shut down in the June-July time period, which negatively affected the bridge debt funds. What are you seeing in the CLO market today?
Yes, it was solely, again, in early June, everyone was freaking out, and it obviously then usually it takes around a month or so until everything is settling down. So just for everyone who may not understand what CLO means, it's a collateralized loan obligation, and that's really what these bridge loans are. And all of these loans, or a majority of these loans, even though a lender may say we are a balance sheet lender, we keep it on our balance sheet, the reality is that most of them are actually packaging these loans and securitize them and sell them into the marketplace, right? I briefly touched on the great financial crisis on the residential side. It's the same thing there, right? So everyone originates loans. Obviously, on the residential side, instead of let's say 50 loans in a bond, it will be 2,000 or whatever, 3,000, whatever it might be. But the process is very simple, meaning these lenders are originating these loans. They get a so-called warehouse loan from a Wells Fargo or Bank of America or some of the other large banks that funds them at the interim basis to do that loan with you as a sponsor, right? So it sits on their balance sheet during that time. A large portion of that loan, let's say if it's a $10 million loan, let's say 8 million of that was funded by Wells Fargo through that warehouse loan, and 2 million was funded through their own equity. So naturally, the goal is of these lenders to package all these loans that they have originated in a month as quickly as possible and sell them in the so-called CLO market. And that's what John was referring to in June and then into early July, because interest rates increased drastically, because the Fed clearly showed a signal of a much more hawkish behavior. The debt markets freaked out. All these loans that were originated the previous 3 to 6 months by all these bridge lenders, the market, the investors in these loans said, "Oh, we don't like that. We are rejecting that." So there were several bridge lenders that went with billions of dollars into the market in June, and they didn't find any buyers at these at the conditions that these loans already were in. Remember, these lenders, they take the risk, right? So if I as a lender originate a loan today, I need to anticipate how much my profit margin is going to be once I sell that loan in 3 months into the CLO market. And as long as the market is stable, I know that I make that profit. But if the market suddenly freaks out, suddenly you're upside down. And that has happened in June and July. Now, that was a brief period of time. Same thing has happened in March of 2020 when we had COVID-19. And the good part this time around was that there is still so much liquidity in the market that some lenders have exited, some of them have scaled back. But because of all that liquidity in the market, you have other lenders that immediately stepped in that haven't been as aggressive and could pick up the pieces from whatever lenders haven't been willing to do. So other lenders haven't been willing to do. So as a result, even though the pricing only has increased for the right deal, there is still bridge financing readily available. Right, so it's not, and even, I must say, even in June and July, yes, the pricing shot up. Yes, a number of lenders disappear, but clearly there is still interest in it. For us as step brokers, it has changed dramatically. Right, until 6 months ago, typically, we went out to maybe a dozen lenders and we were able to get very aggressive quotes. Today, we probably go out to 50 lenders to get the same number of quotes. So it's certainly much more of a function of finding a needle in the haystack of lenders than it was before, because you never know, whoever was willing to lend a week ago, they may not lend today and vice versa. So it just takes more work, but there is still plenty of liquidity in the market, luckily.
Great, thanks, Anton. We're seeing that even on the sponsorship side, where any sort of capital raising, whether it be debt or equity, it's definitely requiring, not unlikely a 5x amount of effort to get similar kind of results as what we saw less than a year ago. So we'll also have to keep adapting to the market as it changes. But yes, it's kind of interesting. Next question that we have, which takes a little bit more international scope, which is that comes from Daniel, and it says, I've been advocating for decades about investing in different geographies, aka Europe, and not only the USA or Canada, in order to better navigate the crisis or recessions or other sort of economic phenomena in the real estate space. What do you think about that?
Generally, diversification is good, right? As long as you know the assets you're investing in reasonably well and understand the good and bad about those assets. Now, is there something wrong about investing in Europe? No, not really. Historically, certainly in commercial real estate, the yields have been much lower in Europe, in the good markets in Europe than they have been in the US. And so that's the reason why actually most of the investor money has come from Europe and from other parts of the world into the US rather than the other way around. But if you want to diversify, that's only a valid point. When it comes to Canada, I would say it's the same thing. You just need to understand, if you do direct investments in any of these markets, you really need to understand all the consequences. Right? Investing in a REIT is easy to do because they handle all the legal side as well as tax side, and you get your paperwork from them and you're all done. If you go direct, you will be faced with a lot of hurdles in all of these markets, and you really need to understand how to navigate it also from a tax perspective. And ask some Canadian investors that started investing in the US, some of them made errors initially until they actually understood how to properly invest in the US, and they have been very successful. So if you do that in Canada or in Europe or any other market, you just need to go through the same process.
Okay. Next question is a little more simple, but it says, are those international loans paid in US dollars currency? If so, then that could be a real game changer. I think we know the answer to this one, but please go ahead and answer that one directly, Anton.
Yeah, I mean, obviously, US-based loans are in US dollars. In Canada, they're mostly in Canadian dollars. Large institutions, they definitely borrow also in US dollars, as well as large institutions in Europe. But the reality is they always do hedges with all these deals, right? So could there be some opportunity to pick up something because someone mishedged? Sure, it could be, but I would say overall, I wouldn't say that really has much of an impact. And again, in the US, everything is US dollar anyhow.
Great, thanks, Anton. Do we have any additional questions? We have time for maybe 1, 2 more. If you have any, please go ahead and type them into the chat box. All right, going once. Any last questions? Going twice. All right, I think those are all the questions that we have for tonight, Anton. Thank you for that great presentation, very helpful. I think at this point, everyone, we'll go ahead and set up the breakout rooms that we'll go ahead and connect shortly. So stand by and we'll get that set up. One moment.
That was a massive exodus.
Yeah, we came back from the breakout room, and then boom, then 2 more people were put into our breakout room. This was the first round, and then tried to get out of that, and we were cut off. Just thrown out. Well, I tell you, I've been thrown out of better bars than this. So anyway, but Anton, I got to say, that was a lot of very good information in the background on how things actually work.
Yeah,
that was knowing the deep dark secrets of how the government works is a very important thing. Or does it work? One of the two.
It definitely is. Yes. Yeah.
Anton, can I ask you a question?
Yeah. Hi, Lena. How's it going?
Yeah, everything's going great. Can I ask you a question? So everybody know if you buy smaller percentage of red cap, cost more. However, you're more conservative. You protect yourself in the future. And why some people able to buy 1% cap says I can protect. Some people say I can't because my floor is more than 1%. I have to buy 2% cap. Why some people have a higher floor, some people have a lower floor? Can you explain to me that difference?
The floor on the loan, I assume they're referring to, it doesn't really matter, right? You can, the lender will tell you what they require as a minimum for the rate cap. And as long as you meet that minimum, you can do whatever else you want, right? So let's say a lender requires a rate cap of 3% for 3 years. And even the floor is at 2% for, I don't know why it would be, but let's just say at 2%. It doesn't really matter if you want to buy, we call it buy down the rate cap to 2.5% for the whole 3 years, or even go with 1.5% for the whole 3 years, you're free to do that, right? The lender will not allow you to buy a rate cap that is 3.25 or 3.5 because they want a protection at 3%. But anything that is better than what the minimum requirement is, the lender doesn't care, right? So if a sponsor says, "Well, we cannot do it because the floor is lower," that's completely irrelevant, because that rate cap is, you do not enter that rate cap with the lender. You enter that rate cap with a third party. And all what matters is that the lender is protected to the minimum that they told you that you need to protect the deal with. And in that example, 3%, right? But as long as you meet that 3% and go better, you're free to do whatever you want.
Yeah, I understand the red cap is with insurance. However, if I look at your chart, you have SOFR spread and all-in rate. Where's the floor shown on that picture, on that chart you show us?
Well, every lender can implement a different floor for their deal, right? So there are no rules, right? So you may have, let's say, the SOFR right now is at 3.05 today, right? The overnight SOFR, the term SOFR is around 3.3, but it doesn't matter. So let's just say 3% as an example. One lender may say our floor is 2.8. The next lender may say it's 2.6, right? So there are no rules of what a lender will implement as a floor whatsoever.
Okay.
So I have a question too then. So I recently heard that like you can buy like kind of like a future on the interest rate. And then there's like this unwinding process. What do you have any clue what that is? Because it was like a rate swap. And then depending on how it plays out on the unwind when you sell, it can be good or bad.
Well, if you have a rate cap in place, right? Let's say a 3-year rate cap, you sell the property, let's say in 2 years, you still have 1 year left, right? So depending on whether that rate cap is so-called in the money or out of the money, it has value or not, right? So let's say you have a rate cap at 3% and the SOFR is at 4%. Someone would be willing to pay some money for 1 year of a 3% rate cap that you pass on to them, right? Whatever that is, and that's negotiated. If it's the other way around, let's say if SOFR drops down to 2%, then there is much less value to that 3% strike. There is still potentially a value, but because you are just 1 year left, buyers will likely not pay you much for that remaining term. But what I'm saying with this is it's a contract that you have entered and that contract has value. And if you are willing to give up that contract before maturity, you potentially can sell that, right, to someone who has the need.
Yeah.
Oh,
Always look at all your assets, right?
Yeah, it's essentially an asset that you have, right? Obviously, as long as the loan is in place, it's an insurance policy that you cannot give up because the lender requires it. And even if the lender doesn't require it, you probably want to keep it in place to be safe. But once the loan is repaid or you sell the property, then now you have that insurance policy that you don't really need unless you happen to have another deal. and you have a marketplace for these, right? So how much are you going to get for it? Well, that all depends at that point.
Would your best market be the next owner?
It depends what that lender of the new owner, first of all, what type of loan they are entering into, and
Okay.
what that lender requires, right? Potentially it could be, right? If rates are, let's say, in a very similar position as they are today, so maybe that could be applied to that. But it also needs to be balanced out whether it's just cheaper for them to buy a new rate cap rather than combining that one and then adding another one in year 2 and 3, right?
Very good, very good. An example of smart money.
Yeah.
Yes. Well, I've been hearing the call of dinner, so I'm going to say goodnight to everybody. We'll see you probably in the next, 3 or 4 times in the next week. I know I'll see you, Angel. Good deal. Well, good night, everybody. Have a good one.
Yeah.
Bye,
Good
Ken.
night. Yeah. So I have to get going too. So it was a pleasure seeing you guys, right? And have a good night. And if you have any questions,
One more question, Anton.
excuse me.
One more question.
Yeah.
Preferred equity and mezzanine loan, are they the same thing?
Oh, they are called differently, so they cannot be the same.
They call differently.
Yeah, they have a different name, and there is a reason for that, right? So, pref equity is preferred equity, which is really equity. It's just preferred, and a mezzanine loan is a loan. And that mezzanine loan is debt. That's right. Yes.
Preferred equity is equity.
And it's but the mezzanine loan is not secured by the property itself, right? So it's not a lien. You actually pledged your membership rights as a GP in the borrowing entity, right? So as a GP, you essentially you have that mezzanine loan, and if the mezz lender has to take over because you are not performing, they are taking over the GP position at some point, right?
So they do that as opposed to taking second?
They can consider second lien.
Yeah, but it's not a second lien because the first lien lender will not allow a second lien in most instances, right? So banks sometimes do, but Fannie and Freddie, they do not allow it unless it's a supplemental that's different, right? But they do not allow so-called hard pref equity. Any pref equity that has a hard type of, almost a debt type of structure, they will not allow it. And mezz loan is also not a second lien, so that's why they will allow it, right? So that it's not really that you can foreclose on the property as a mezzanine lender. You kind of can foreclose on the borrowing entity and take over the borrowing entity, and then you control it, right? So that's what the mezzanine lender has as a backstop if you do not perform.
Oh, okay.
Yes.
They have higher priority than equity partner, for sure.
Well, they have a higher priority than the passive investors, but they do not have a higher priority than the senior lender, because the senior lender is the only one that actually has a lien on the property, right? As a mezzanine lender, you do not have a lien on the property itself. And as pref equity, you do not have a lien anyhow.
Okay.
Mr. Mattli, it's Camille here. If I understand well, I know you're about to leave. It's just quick. So they only have the power, quote unquote, on the equity on the JP position, and so they are creditors, but the pledge is an equity position in case they have to take over. They're not second, and they don't have any power to take the position of the first position, of course, because that's a first mortgage. Am I saying it right?
Yes, that's correct.
Thank you.
However, what they will achieve with that is that they are able to gain control of the borrowing entity, right?
Borrowing entity?
Yes.
Borrowing. I see. Okay. The equity investor. Yes. And
yes.
the
So
sponsor. And
they kick out the sponsors, right? Yeah. So instead of if you're an LP in that type of a deal and they do not perform, instead of, let's say, me as a sponsor initially, they kick me out, and let's say Angel is the mass investor. Now Angel would take over, and you as a passive would now have to work with Angel on that deal, and I'm out, and I lost essentially everything, right?
And you failed to execute the business plan or add value or name it, and they come.
That's
okay.
Right.
Okay.
Yeah.
Thank you so much.
Thank you.
Hi, Anton.
Hi,
how are you doing? I wanted to get your feedback on, how is the mood for pref equity currently? What percentage of the raise are they doing these days? Minimum check size, and what type of returns are they looking for? Right?
Yeah.
And generally, any particular type of properties that they're kind of avoiding to do?
Yeah, I mean, it's still money there for multifamily, for true value add. I would say they just have been much more picky. It's actually easier on the construction side still to get pref equity in place for experienced sponsors. Now, I would say on the so-called value add side, it's mostly the shift definitely is towards better sponsors and the core cities, right? So let's say, whereas someone may have been willing to do Wichita Falls 9 months ago, they probably will not do it today. They want to stick to Dallas, right? So there's kind of that shift to better quality assets and locations. And I would say that's what I would focus on. 5 million and less is really hard to come by. So most of them now are in the 5 and 10 million plus. Right.
And what percentage of the equity are they going up to?
I would say you still can get up to maybe 85%, but I would say somewhere between 80 and 85 is typically the cap for value add. For construction, it's a little bit different. There it can go higher. I mean, for very high quality sponsors, it can go 90 plus.
Mm-hmm. So how many projects kind of do they look for from a sponsor?
On the value add side or on the construction?
On the value add side, yeah.
I mean, everyone now wants 90s plus properties, right? Once you're 80s, it's already more problematic, and once you hit the 70s and 60s, no one wants to touch them. So that's actually with a lot of lenders the case. So like when we go out, I mentioned we go out to now typically to 50 lenders for every single deal. And if it's a 60s and 70s property, I already know ahead of time that probably half of them will come back, oh, vintage doesn't work for us, right? So that's definitely, I would say, the key to stick to ideally 90s and up, but at least 80s. And again, I would say, if possible, avoid tertiary markets. Now, that doesn't mean that there are not good deals. Obviously, like Angel she has the market knowledge, right? But typically the deals are not big enough in those markets, or most deals are not big enough. And the lender appetite is just not that big as it was 12 months ago.
Got it. And do you, like, in terms of the control, they're asking, like, are you seeing syndicators still kind of take pref equity and, work with them? I've heard some stories about, pref equity products backing out at the last minute, and also too strong conditions, that they prefer not to take it.
Yeah, I mean, that's always the problem with when you have a large Czech player coming on board, right? Pref equity, you need to understand who is active in pref equity, right? So they are clearly in the game to maximize their returns, and they are a pretty smart bunch of people, right? So they smell blood when there is blood, and unfortunately, usually they are approached when there is already an issue in a deal, and as they go through the deal and learn more about the deal, then they sense that there is a real urgency, and the more urgency they sense there is, the tighter they are going to screw the nut, right? So that's just that's the way they do it, all the way to the point where the sponsors say, "Oh, we cannot do that anymore." We have seen a case where pref equity actually announced that they will not do the deal. That was on a Friday. And then on Saturday, they said, but if you want to hand over the deal to us, we are happy to do it, right? So they walked out of the deal knowing that the sponsors weren't able to raise the funds. And so then they took over the deal. The sponsor got some money. They didn't lose any money, right? And the pref equity ultimately stepped in as the deal sponsor, right?
They stolen the deal. That's not good.
Oh, it's good for them.
It's good for the pref equity because they played it right. Is it ethical? No, it's not. But once you operate with these large Czech operators, don't expect ethical behavior, right? So you need to understand that they are kind of in the ring with other players that are very similar to them, right? So they know the smartest guy wins, right? And sometimes we win, sometimes we lose. Hopefully we win more than the others, right? So they apply the same principles when it comes to the deals that they are approached with these syndicators, right? So you just need to realize that they have a very different worldview, and it's definitely ethics or is not on top of the list there, right? It's nothing illegal, but it's only not nice, right? And as a deal sponsor, you just need to understand that many of the pref equity players operate that way. Right?
Yeah, I also heard some last minute pull the trigger and say some other deal come along. I no longer interested. That causes problem too, because unless the GP have a quite big backup plan, otherwise last minute almost ready to close, they don't have money anymore.
Yes. So I always recommend not to rely on, in the syndication space, not to rely on these large checks, right? The risk is just too high, right? You're better off trying to find a large tech investor and go through that process than attempting to get pref equity, right? On the surface, it looks very easy, right? So now you immediately get your 5 million or 10 million in pref equity. You don't have to bring in someone else you need to share the GP piece with. So it's on the surface, it looks great, but you're really taking a massive amount of risk when you go down that road. And reality is sometimes loans fall apart, right, where lenders walk away. So pref equity providers, they can walk away too. And again, while lenders actually want to do the deal, a lot of pref equity plays it strategically, and they may pretend to walk away to improve their terms, or they actually are willing to walk away because they have an order deal that actually looks better in a similar market. So now they just drop this one here, right? So you need to remember, right? It's not like the lenders that have the servicing side where they make money after they close the deals. It's really much more transaction by transaction basis. And if there is a better deal that comes along, then they drop this one here, right? And they may squeeze you, and if they see that they cannot squeeze you enough, then they walk away. Right? So it's not a nice world, right? So there are a few good players, but generally, I would say a majority, you just have to acknowledge that they are not there to be your friend.
So can we think of them as a strategy for at least part of the raise, or what do you suggest as
I wouldn't, right? So because again, whatever they tell you, they are taking a preferred position, and you already know that they are in that preferred position to begin with, right? And if you start the discussion early on, the risk is only smaller. But I still would say the question is, who are these? Who are the people behind it, right? So not all pref equity is bad, right? But if it's a debt fund or a so-called pref equity fund, whatever it is, be very careful, right? If it's a family office or a private individual, then it's a different story, right? They still can drop out because you have personal situations and all that. But when it comes to pref equity funds or debt funds that do both, you just have to be ready for them to shift at any given point, right? So
Correct. And what type of returns are they expecting these days, in terms of cash interest returns and also the total returns?
Yeah.
Well, 14%, like
well, the accrued is typically 13 to 15. The cash, the current pay is somewhere between the 7 and 9, right?
It's pretty high, right? Like it's almost same as LP thing, right? Yeah.
Well, it's actually, in my view, it's not high, right? Considering how much interest rates have moved, the pref compensation has not moved along that, right? Because even when we were at interest rates that were at virtually zero, with SOFR as an index and borrowing cost was at 3%. The current pay was in most instances somewhere between 7 and 8%. Sometimes it was 6, but most of them were 6 to 7, 7 to 8. And the accrued was somewhere in the 12 to 14, right? So considering that we now have the borrowing cost essentially having moved up by 3 to 4%, the pref compensation has not moved up nearly as much. So in that respect, it's actually pretty cheap money. Now, if you say, well, that's similar to what you're offering the LPs, well, then you have really good structures in place where the LPs are happy with a total return of 14, right? So I would say still most deals, the LPs still expect something close to the upper teens, right? Is it close? Potentially. But remember, pref equity plays another role than what the LPs do. The purpose of the pref equity from a sponsor perspective is really to get them in initially and then take them out at the refi, right? So that's the strategy, not that you keep them in for the whole life of the deal. So yes, maybe the return for the period that they're in is not that far apart from the LPs, but it's really meant to be for a shorter period, and then you take them out, right? That's in theory. In practice, particularly when I look at some of the deals that were done over the last 2 years, they are not even close to being able to take them out. So that pref equity will stick around all the way to the end of the deal. And the LPs will see very little return, in my opinion.
Mm-hmm. Yeah, great thoughts. Yeah, makes sense. And do you have access to the pref equity providers? And like if at all we have some deal that pencils?
Yeah, I mean, we know all the pref equity providers, right? So it's not that we do not have access. It's just that we, again, put that big asterisk with every single deal. Look, here are offers, just realize who they are, right? Because it's just a very, if you have to rely on them, you just have to realize that whoever was doing a great deal yesterday and was reliable, they may not be reliable this time around, right? So do we have access to them? Sure we do, but we still kind of warn over and over whether you really want to go that strategy, right? Because essentially in the current environment, unless if it's a ground-up construction, it's a little bit different, right? But for a value add, if you really need pref equity, you have to really ask yourself, do we take down a deal that is too big for us, that we need to go to pref equity, right? And that's really for most sponsors why they go to pref equity. It's not that there is a strategy behind it. It's mostly because they cannot raise the money, right? And that is, in my view, is not really the right reason to go for pref equity. And that's where we always set that warning out, right? So if someone really has a strategic plan for pref equity use, then it's one thing. But I have yet to see value add deal by syndicators that had any strategic reason behind getting pref equity in place.
What would be a good reason?
So I like that idea of like, not having to keep them all the way until the end of the deal, right? Like just take them out and, get the property in a position to refi out. and then get them out, right? So unlike other investors that you have to keep them until the end of the deal, right? So I like that portion of the pref equity.
Yes, I completely agree with that. And Camille, you asked that question, when is there a reason why it makes sense strategically? And that's one of the reasons. The problem I'm having with 99% of all the so-called value add deals I have seen that have taken pref equity, they are not value add enough to justify that as a strategic element, right? So you need to have a massive upside in the deal so that you are not struggling, as long as your business plan works, that you are not struggling to take out that pref equity at the refi. A majority of the deals that we have looked at, they are already in good times. They barely are able to repay the pref equity, right? And that is what I'm saying. That's not strategic. That's just not able to raise the money. If you have, let's say, a 50% occupied property, a complete disaster, you get a really good price, you put in plenty of capex, and you are able to raise the value very quickly, then the strategic place of pref equities only comes into play, right? Unfortunately, very few value add deals out there have been done that way.
Yeah, we're looking at gap funding. We've got, if we're not able to raise the full amount we need, we've got a friend that'll gap fund us in.
Yeah, I mean, if you have a friend that does gap funding, that's fine, right? We actually have done ourselves gap funding, but we are opportunistic, right? So we do it we are never just doing it on personal guarantees. We always go for assets, right? So if someone has personal assets, a house that is free and clear, another property that is free and clear, then we put a lien on that, and then the gap funding comes in. It's still expensive. I don't know what your friend is offering, but it's certainly not cheap.
Well, and it's you put up a position, like a GP position in another deal. There's things you can put up, but we're hoping to not have to use it.
So how much is he charging?
I have no idea.
Oh, okay. Yeah.
But he has access to about 20 million of his own.
Okay. Yeah.
So he's just a good friend to have.
Yeah, sure. So it all depends how much he wants to charge, right? So for these, I mean, we haven't done gap funding. We mostly do reverse 1031s where people don't have the money in place to buy the property and then sell the other property later. So that's it's similar really to gap funding, right? It's a lack of liquidity on a short-term basis, and we are able to get all-in compensation somewhere between 12 and 15%, right? And people are willing to pay for it because it's the value is much bigger for them from a tax perspective to do it, right? So now when it comes to you for gap funding, obviously you always have to ask, what can I pay that it makes sense, right? If the gap is so that you do not lose the deal, then you probably are willing to pay also your 12% or more, right? But if the pain for you is not that big, then you may say, well, I'm not willing to pay for that, right? And that's really brings me to the same element of pref equity. At some point, the pain point for you is so high that you say, sorry, it's not worth it.
Well, I'm just hoping that my friend wouldn't put the same pressure on me as pref equity, because pref equity, if a better deal comes along, they're dropping you. And I don't know that it's necessarily unethical, but it's definitely unfair.
Yeah. I mean, It all, I mean, again, right, unethical and fair, it all falls into the same category in my view, right? Either you behave in a fair fashion, which is ethical, or you don't, right?
No, I mean, I agree, but like you said, they're in a different ball game.
Yeah.
And if
For them,
I mean, if they've got a big
okay.
enough chunk of change they're putting in, and it's a 2 or 3% interest rate difference, and as far as what they're going to earn, 2 or 3 point difference, then honestly, it only makes sense to go ahead and go with somebody that's going to pay you more. And for us little fish, it's painful and it's unfair. But for big fish, they're doing what's best for them, and you know that's just kind of the way the cookie crumbles.
Sure.
And just one last thing. So in terms of the metrics that you would want us to look at when if you want to factor in getting pref out in or refinance, right? So you mentioned about the value add and all that, right? But just in terms of metrics, like what would be good metrics to watch out for when we are taking in pref equity to make sure that we can refinance them out in a couple of years, right?
Yeah, I mean, I would say first look at your yearly NOI until stabilization and how much of that money goes to service the debt, how much is free, and that can be paid to the pref equity as current, and how much is not there, right? Because then it goes into accrued. And once you refinance, you need to look at how much to have to pay in accrued on the pref, and what's the capital have to return, right? So is my NOI sufficient to refinance that deal into a permanent loan? And on top of that, also the refinance also need to cover to pay back the pref plus any of the accrued that you need to be paying to the pref, right? So that's really that NOI is driving this, and obviously you need to be conservative enough with your interest rate assumptions and amortization that you're able to get that refinancing in place, right? And right. Again, that's what I'm saying. A lot of these deals, they barely make it. A lot of them actually don't, because the sponsors do not even understand how to calculate it. But you need to have, it's for me, a good deal is not when you just barely make it in your pro forma. You should have at least a 20% to 30% cushion, in my view, right? If you don't have it, then it's very likely that you will not be able to pay that pref equity back. And then the deal is just not strong enough to really bring that strategic pref equity, right?
So that would mean a minimum the SCR of 1.3. That's how translate that.
It depends on the market. Usually in most markets, large markets, it's 1.25, but with a 30-year amortization, right? So that's also important that you understand, right? Even though you get interest only, the actual DSCR test is including amortization. So it includes the principal for, if it's a 30-year amortization, for that 30-year amortization and that interest, right? And that's what determines the DSCR, not just the interest only, just because you have 3 years of interest only.
Thank you.
Yeah, I have seen some preferred equity deal at the beginning. They are able to distribute something. Now, because of preferred equity obligation, the market is turning, they're not able to pay. Or some deal at the beginning, the structure that pays preferred equity in order to buy them out sooner. So the limited partner will get nothing for the almost 1 year or two, just waiting for their paying those preferred equity and get them out. So that's almost like a new development deal. In that case, the development deal, you will probably getting paid after 2 years.
Well, the new development is really, it's different because you have a much higher value add already built in as part of the deal, right? And this is again bringing me back to that value add question, right? If it's a true value add, then it's a very different story. If you have 50% occupancy, 60%, 30 units, 30% of the units down, that is a true value add. If you buy a property that is already 90% occupied and you put in 5,000 per door in upgrading units, that is not sufficient as a value add project, in my view, to bring in pref equity, because the NOI bump is just not strong enough to pay the pref equity back at the exit, right?
Yeah.
And so that didn't work even in the best of the times. And we have seen plenty of these deals, right? We look at their underwriting all the time, where they had a short term, the borrowing cost was at 3 to 3.5%, and they put in pref equity and assumed that they can refinance at 3.5% or maybe 3.75 for an agency loan. And now that same agency loan will cost them 5.5%. That kills that. They are not able to refinance the bridge loan, plus also, remember, it's not just refinancing the bridge loan. You need to have enough NOI with that 5.5% interest rate to also cover the bridge loan plus the pref equity principal plus the accrued interest, right? A lot of these deals are not able to achieve that. So now, what does that mean? So now that pref equity continues to be in the deal, still is collecting that 14% or whatever it is of accrued, and only when they sell the property will the LPs hopefully see some return, right?
Yeah, that makes perfect sense, because that's exactly.
So, Anton, when do you start seeing deals? When do you expect to start seeing all these people who bought, syndicators who bought properties on bridge loans, with these low interest rates, and now they're at a time they need to refinance, and the NOI doesn't support, and they can't do a cash call, and they have to sell, right? So when do you expect to start seeing them, and when you see the bulk of all these sales happening?
Yeah, I would say the ones that are in trouble because they are not operating well enough, they will come online next year and in 2024. Right, a lot of these deals were taken out in 2020 and 2021. Usually they have a 2 or 3 year long term. A lot of them have 3 years. So whatever was taken, I would say it's only 2024 is more likely when you have more that are struggling. And right now, all of the sponsors hope that interest rates will come down by that point so that things all work out for them. Because that's the only way that it's going to work for them, if interest rates drastically come back down in 2024, right?
Right.
That's too risky. Even some people 3 + 1 + 1, they may not qualify to get that extension either, right?
That's the problem, right? Because a lot of them, right? So you have the SCR and or debt yield requirements. And if you are not performing well enough, you're not able to extend, right? So then you need to sell or you need to refinance. And if you need to refinance, then you will likely, because the NOI is already underperforming, you're not getting enough loan proceeds to refinance the bridge loan. Never mind the pref equity if you have pref equity. A lot of sponsors even without pref equity, right now would have problems to refinance their bridge loans if they had to refinance them right now, right?
Yeah.
Right.
Yeah.
Yeah. So it's, I mean, everyone who went with 80% leverage, right, maximize the leverage. A lot of them are right now, if they had to refinance today, are underwater, right? So what they can hope for is that interest rates will come down by the time the refinancing is going to happen. And for a lot of them, obviously that took them out in 2020. It's not in 2023. For most of them, it's in 2024. But you also have to remember some of them are underperforming regardless. So then they have are putting under pressure by the lender, and they may want to refinance or get out of the deal earlier, right? But is there going to a mass situation like this? It's hard to tell, right? How many are going to really suffer through? And even if someone wants to sell, are there going to be opportunities to buy? I would say yes. Are you getting an absolute bargain? I'm not so sure, because there is a lot of liquidity still in the market, right? So there's still a lot of equity that wants to get into multifamily. So unless that equity disappears, there is a lot of competition for these deals that are struggling. So they're actually getting a better buyout than if there was not that much liquidity in the market.
Okay.
Mr. Mattli, are we seeing a lot of bridge lending, bridge loan extensions, and is it a typically an expensive alternative?
Well, if it's baked into the loan, right? So
Half percent origination fee, right?
yeah. So depending on what the loan has, what the arrangement is with the loan, the extension fee can be anywhere from a quarter point to 75. Sometimes it's even a whole point, right? So it's deal by deal. That has been negotiated with the lender. Is it common? Not really. In the past, it hasn't been common. It remains to be seen whether we now see more and more. So only if these deals if interest rates do not come down, a lot of these deals will want to extend with the hope that rates come down so that they can refinance later, right? So I would say it's only 2023 and 2024 see more extensions than we have ever seen.
Thank you.
Do they still expect this, DSCR of 1 for rate extension? They would have already started escrow. So yeah, what kind of terms, like the rents would have increased quite a bit from like 2020, right? So in terms of higher rate payments, like what kind of terms do they have at extension? Is just a DSCR of 1:1 or?
Well, it all depends. It's really deal by deal. There are no rules, right? Whatever they baked into a deal, it's all negotiable, right? So there are no rules attached, but generally the extension covenants are not too far off from what they expect as a stabilized property. So that's why some will struggle to extend because if they are not able to achieve the NOI. Right? All right, guys. So I need to get going here.
Thank you so much.
Thank you.
It's very, very valuable
Yeah.
answer and advice, and truly appreciate your time.
Yeah. Thanks for having joined us, and hope to see you soon again.
Yeah.
Yeah.
When you have event, definitely will be on. Thank you.
That's good.
Thank you.
Okay. Bye, guys.
Thanks so much, Anton.
Thank you. Bye-bye.
Bye-bye.
You're one of the few lenders who goes into so much depth, and it's always a lot of a lot of fun, and it's engaging talking to you. So really appreciate
Good.
your
Okay.
Yeah.
Bye, guys.
Thank you.
Bye.